Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to a brand new episode of MuslimFin. I'm your host, Ali Sali. We have an exciting episode for you this evening, and here to introduce our guest is my good friend and colleague, Siraj Buzik. Siraj?
Assalamu alaikum wa rahmatullahi wa barakatuh. Ali, shukran. Another week, another podcast. And alhamdulillah, today we have the pleasure of speaking with Abdulaziz Davids, the head of research at Camisa Asset Management. With a distinguished career in the financial sector, Abdulaziz has played a pivotal role in shaping investment strategies, particularly in Islamic finance. However, I'm going to hand over to Abdulaziz to give us some background about himself. Abdulaziz, welcome.
Wa alaikum salam. Shukran for the opportunity. I don't know if I did a pivotal role in the Islamic finance industry, but maybe to answer your question, a bit of background about myself. I started out as an accountant, believe it or not. So I'm actually what I call a failed accountant. Never passed the board exam in terms of the CA qualification for various reasons. But started out in the finance industry in 1998. I don't know where you were born by that time already.
1998? Yeah, I was still in diapers.
So yeah, I started out at a company called Allen Gray. I don't know if I'm allowed to mention my employers and companies. But yeah, I started out at Allen Gray, and really the reason why Allen Gray initially employed me was to set up the financial systems and the investment systems. Yeah, part of the reason was that I did accounting, but I also did some programming.
Okay.
And before we have AI today and all of these high-tech stuff, sort of computer programming was quite novel and cutting edge back in the day. And back in the day, we were moving from what they call a DOS, or disk operating system environment, to a Visual Basic environment. So that was quite an opening for me to get into the industry. And given that that's now 26 years ago, which is a long time. I mean, you can see with the gray hairs, it's been a long time. But effectively, part of the task at hand at that stage was to improve the systems. And today, all of the systems that most asset managers use was actually that migration that happened from the old Microsoft DOS base to a Visual Basic base. And software programming, engineering, all of those things, the foundations of it was that Visual Basic programming, which we did way back 26 years ago. So, just to giving a long answer to
No, this is great. Keep going.
A short question. But the real introduction to Islamic finance happened about 15, 16 years ago. My time at Allen Gray was exciting. It was interesting. I learned so much about markets. I never knew what a share was before I joined Allen Gray, and they introduced me to the financial markets. And my ambition was always to manage Islamic money and Sharia money, and to bring Sharia-compliant investing to our community. Unfortunately, that opportunity wasn't available at Allen Gray, and my current employer, Camisa Asset Management, their previous name was Kagiso Asset Management, so they recruited me in 2008. So I was at Allen Gray for about 10 years, and they recruited me in 2008 to, first of all, head up the investment research process. I'm head of research, as you've mentioned, but also to set up the Sharia funds at Camisa Asset Management. And back then, that's 16 years ago, it was a tough time because it was a smaller asset manager. When I was at Allen Gray, we grew the business from about 10 billion of assets. By the time I left Allen Gray, there were 360 billion of assets. So it was a large company, a very successful company, and now almost to start over again, because Camisa at that stage was 7 billion in assets when I left Allen Gray. So it was never about money or remuneration. The ambition was always to bring a product to our market and to our community, which, given my experience at Allen Gray, and at that stage Allen Gray was perceived to be the asset manager, the professionalism, client service. If you look at asset managers today, Allen Gray still ranks tops in terms of client servicing and customer interaction and transparency as well. And I wanted to bring those elements to the Sharia market, which I think is quite important. It is a smaller market, but the big opportunity that we have is to dispel this myth that Sharia investing has to stand back for conventional investing, and that Muslims or even non-Muslims that want to invest in Sharia have to take a knock, either in terms of performance or in terms of client service or transparency. So that journey started 16 years ago, and it was a rocky start. We needed 1 million rand to start our first fund, and it was a struggle to get 1 million rand. But alhamdulillah, today we managed about 8 billion in Sharia assets from that 1 billion 16 years ago. And we've got a full suite of funds, which we'll hopefully talk about later in the podcast. But that, in a nutshell, is the background. We have won awards. Earlier this year, I was in Jeddah to collect a Global Finance Award for our Islamic Equity Fund. So that's quite nice because it's a team effort. I always say, it's like the Oscars. You go up there and you have to thank your parents and you have to thank but I always thank the team because it is a team effort. When we underperform, it's me that's underperforming and I take full responsibility for it. But when we do well, it is a team effort because all of the opportunities, all of the investments that go into the fund, it's not just me. I've got a team behind me. And I think it's important to acknowledge that. But what is nice about these awards is that it's global recognition for what we're doing. In South Africa, I think we're in a fortunate position that our capital market is fairly well developed. We've got pension funds, retirement funds. So the opportunity set available to us to grow the market and to introduce new funds is much better than other areas of the world, even in some Muslim countries and Muslim domicile countries as well. So I think we're in a fantastic opportunity and space at the moment. And yeah, that in a nutshell, it's a very long nutshell, but in a nutshell is the background.
Wonderful, and shukran for sharing that with us. I know that you have a little presentation for us today, so you're going to give us some insight into the global economy.
Yes, okay. So we've got the slide back. The first slide is the most complicated slide, so I'll take a minute to explain it, but I wanted to start with that slide because it is quite important. And just today we had a client interaction, and I think there are three things that people are worried about, that people are talking about. Firstly, and uppermost for us in particular, is geopolitical issues. What's happening in the Middle East, what's happening, with the wars there, and the implications that has on the global economy, and the outlook and how it affects people. So I wanted to talk about that. I wanted to also talk about, people always ask me, is now a good time to invest? And should I be investing in the market now? And I always say that if you've got a long-term time horizon, if you're saving for Hajj, if you're saving for your kids' education, if you're saving to buy your first house, for example, and those goals are more than 5 years in duration, now is as good a time as any to get into the market and to get exposure. I'll be sitting on the beach if we could time the market and really say, okay, today we have to buy shares and tomorrow we sell them. But that's a very difficult thing to do. But that is also the beauty of markets, in that it is what makes it Sharia compliant, because that risk element is there. If it was guaranteed, it would be a bond and it wouldn't be compliant. So what we will do, and I'll go into the presentation, we've titled this presentation The Global Economy and Islamic Investments. And I wanted to start with the global economy because what's happening in the world, what's happening in South Africa and elsewhere is what is shaping Islamic investments as well. So Bismillah, let's go into it. Now, as I said, this is the most complicated slide. Please don't be alarmed. Please don't be scared of. I will take a minute to explain it. But this actually very succinctly describes and summarizes where we are in the world today. And what we have on the screen is effectively, you can see there's various dots with a dotted line going up. On the vertical, so if you remember from your maths in high school, you've got a vertical axis and then the horizontal axis. On the vertical axis, you'll see there what is called the trailing PB. PB stands for price to book. If you think of a price to book, effectively that is the price that you're paying for the physical assets of a company, or in our common language, if one had to look at a house, for example, if your house is fully paid off, your mortgage is done, you've got 100% equity in that house. So that house, if that house is worth 3 million rand and you've paid off your bond, etc., then that is 3 million rand of book value, effectively. If somebody comes and offers you 6 million for that house, you effectively have a price to book of 2 times. 6 million divided by 3. So that's how price to book works, and that's on the vertical axis. So intuitively, the higher the price to book, the more expensive. Obviously, somebody then comes and says, okay, I'll pay you 9 million. That's a 3 times price to book, and you should be selling at that price. So when you go on the vertical axis, the higher the price to book, the more expensive, effectively, these markets are. And these are various countries, but these are the actual stock markets of those countries. And you'll see South Africa is also there in the mix. What we then have on the horizontal axis is what is called the trailing ROE. ROE stands for return on equity. Now, again, let's use the house example. If you bought that house and you're renting it out, now you've got rental income. Now, let's stick with the 3 million rand number. If you're renting that house out for 5,000 rand a month, that in a year you're making 60,000 rand, 5 times 12, Hopefully my maths is okay. Yeah. So 60,000 on a 3 million rand house, that's a 5% yield. It's not a lot, but that effectively is your ROE, 5%. If you could rent it out for 10,000, your ROE goes up to 10%. So that's how ROE works. The higher the return on the asset that you get, the higher the ROE. And intuitively, we want higher ROEs. We want to get a high, I also call it return on effort. We make a lot of effort, we need to get a return on it. So the higher the return on effort, the higher the return on equity, the better it is. So intuitively, what you want is you want to be high on the ROE, but low on the price to book, because that is a great investment. You're getting great bang for buck, effectively. Now, what that line represents is effectively the best fit in terms of where these countries are. So where you want to be is below the line, because then it means that you're low on price to book, but fairly high on ROE. So there's a lot of names and data points here. I just wanted to point out three. Firstly, the US, you can see right at the top, very expensive, very high price to book. That 9 times or 9 million rand, effectively 3 times. You can see they're actually at 5 times price to book. So very high price to book. ROE is also very high. So you can see if you look down, the ROE is closer to about 20%. And part of that is that there's a lot of software companies that doesn't have a lot of book value. You know, they've got high sales, but a lot of their like R&D is expensed. So that makes sense because they asset-light businesses. And there's similarly also high returning businesses like a Microsoft and NVIDIA now, which is the flavor of the month and the new kid on the block. But the issue with the US is that you're getting high returns, but you have to pay a high price for it. And the risk with that is that there's high growth then factored into that market. And that is the key message of this slide, is that the US market is doing well, the US economy is doing well, but you're paying up for it, you're paying a high price for it. India, very similar, very high price, 4.5 times price to book, much lower ROE, about 16% ROE. So India is very expensive. So those Indian companies are not generating the same returns, but you're paying a very high price for that. So we've got very little exposure to India, and much lower exposure to the US in terms of our global portfolio. The other point that I wanted to make is South Africa. South Africa, we've got a decent ROE. We've got about a 13% ROE, and we're sitting at about 1.5, just above 1.5 times price to book, which is fairly normal. So within South Africa, there's clearly companies that are cheap and more attractive, lower price to books, and companies that are expensive and obviously higher price to books as well. But compared to the US, we would say that South Africa probably relatively more attractive. Admittedly, not as high income generating in terms of ROE, but clearly much better value to be found in the market. So that is the context, and visually you can see US market is expensive, India is expensive. You can see quite a whole host. China is actually quite cheap as well. So there's two points for China. China 2012, where China was back in 2012, and where it is currently in terms of China now. So you can see the lower ROE of about 11%, but about 1 times, just above 1 times price to book. So the key theme of what we wanted to talk about today is to say that we're finding value in China, we're finding value in South Africa, we're finding less value in the US. And that is effectively what this slide is saying. So that took a long time, but hopefully I explained that slide as well. And coming back to South Africa, so as I've mentioned, one of the valuation metrics that we look at is the price to earnings. So all the companies that are listed in South Africa, they form part of the All Share Index. And effectively every year they make earnings. So they've got the income statement that they produce, and we get a sense of how much earnings they produce in a year. The PE is effectively the rating or how much you're paying for those earnings. So a high PE rating means that effectively you're paying a high price for earnings. And intuitively you want to pay as low as possible PE multiple, because it means that, let's take a company like MTN. If MTN is generating about 12 billion rand of earnings, if you're paying 120 billion for MTN, that's a 10 times P multiple. If you're paying 60 billion, you're paying a 5 times P multiple. So the lower the P multiple, the cheaper the company is, and the quicker you get your money back in terms of the earnings. So you can see in this graph that the South African market, this is going back to 2006, so almost 20 years of history. We have increased post the election, so elections happened in April this year. So since the election, South Africa's the equity market has recovered a bit, and so the PE rating has also increased. But we're basically on the long-term average. So the long-term average is about 12.5 times PE multiple. which is a lot better than other markets. Most other markets are sitting above the long-term averages in terms of the P ratio. And that's why we say South Africa, less attractive now given the last couple of months move, but still relatively attractive versus other markets in the world as well. Just a few more slides. I'm almost at the end. Now, part of the issue that we're looking at is inflation. And, when we talk about investments, the key reason and the key objective that we have, other than saving for financial goals, like going for Hajj or buying your first home, is to protect your money from inflation. Now, 2 years ago in South Africa, we were sitting with 9% inflation, 10% inflation. That means that if your money didn't grow by 10% a year, you were actually getting poorer. And how inflation works is that it's the average price level of a basket of goods and services. From 1 year to the next, if it increases by 10% and your salary or your income doesn't grow by 10%, you can't buy the same amount of goods and services next year compared to what you could buy this year. So again, CPI or inflation is a measure that we look at to say, in a market like South Africa, is there high inflation that means that we need to get better investments to compensate for that inflation. So again, this is just a chart that shows you on the right-hand side countries with high inflation, and then on the left-hand side, sort of the inflation for various companies as well. So effectively, the compounded annual growth rate, which is what the CAGR stands for, in the cost of goods for these companies that are all listed in South Africa. So some of them are companies that are exposed to what they call consumer staples. So these are your fast-moving consumer goods, your groceries type companies. And you can see them, they're basically in the green there. And some of them have had very high inflation, and they've passed it on to the customers. And that's why if we speak to people, they feel poorer because they say, bread has gone up by so much, potatoes has gone up by so much, there's actually a potato shortage, and as a result, it's been a massive inflation. Whereas the actual inflation, the red line, you can see there, roughly about 5%. But there's clearly companies that have benefited from high inflation and companies that, are actually struggling to pass on some of that cost increases. So again, our strategy is to try and get exposure to those companies that has what is called pricing power. They've got the ability to price for that inflation and keep their profitability intact. And hence you see some of the names on the screen there as well. Another area that we are watching and monitoring is the oil market. As we know, with the issues in the Middle East, an interesting fact is that, there's currently this, and I just heard over the radio this afternoon that apparently Israel has already prepared their plan to attack Iran. And the big question over the last couple of days was, will Israel sort of attack or fire at Iran's oil infrastructure? So initially the oil market picked up, and then when it was sort of said that they're not going to do it, it sort of fell back to about $70. So oil is currently trading at about $70. The one issue with the oil market is that 20% of the world's oil moved past the Strait of Hormuz, which is right next to Iran. So in a scenario where that channel is blocked or choked off, it will have dire implications for oil prices, admittedly in a short period of time. But clearly we've got elevated risks at the moment for the oil market. But what we are actually seeing is, and you can see, the supply and demand dynamic. Demand has been fairly soft. China in particular has been a soft market. And the key theme globally is that China has been very disappointing in terms of the consumer growth, in terms of the overall GDP growth. And we're seeing that manifest in commodities. We're seeing that manifest in the oil market, for example. And that's why oil prices, and the good news for South African consumers, we've had four months of price decreases because the oil market has been soft and because the rand has been fairly strong as well. But we have to thank China for that, because the lack of demand and demand growth has put a dampen on oil, notwithstanding the global tensions that we've seen in the Middle East as well. So this is a busy slide. I'm not going to go through it in detail, but the key points here is that those PEs that I've talked about, you can see that a lot of these markets are fairly expensive. At the top there, let's just talk about the S&P 500. It's the biggest sort of global benchmark for US valuations. Their current PE multiple, as you see on the first column there, is about 21.8, which is substantially above the long-term average. So you're paying 21 times for the current earnings of the S&P 500 companies. And even more astounding, If you take the top 4 companies that make, so that's S&P 500 is the 500 biggest companies in the US. Just taking the top 4, the average P multiple is close to 40 times. And they represent almost a third of the index. So that index, notwithstanding that you've got 500 companies, the top 4 companies is 30% of it. The remaining 496 is 70%. So you can see it's a very skewed index, and those 4 companies are very expensive in terms of their multiples. So again, a reason why we would be cautious on the US market, notwithstanding the economy doing well in that market as well. Now, the big backdrop for us and what we can look forward to in South Africa is, I always call it the Christmas bonus from the Reserve Bank, because they might cut interest rates with the last meeting for the year. And part of the reason is that our inflation is fairly well controlled. I mean, our last CPI number was 4.4%. That is bang in line with the midpoint. So the Reserve Bank wants inflation to be between 3 and 6%. If you take the midpoint, that's 4.5%. Our number is there. And with these fuel prices coming down, that is also quite good for inflation as well. So we think that there's potentially another interest rate cut coming just before Christmas. And part of it is because we've seen other countries also cutting rates. In the US, they've been cutting rates and in Europe as well. And you can see what this chart basically shows is the monthly number of rate cuts. And currently, globally, we've seen similar cuts to what we've seen during COVID. Obviously, COVID was an extreme outlier. The global economy grinded to a halt, so they wanted to stimulate the economy, and a lot of countries, South Africa as well, we cut our interest rates by 5% in that 1 year of COVID as well. But we are on track for similar, not as much, but equally aggressive easing, as we call it, in terms of global cuts as well. So all of this sounds great and it's good news, but there is an elephant in the room, and the elephant in the room is global debt. So as we know, most countries built up a lot of debt prior to COVID, and then that debt accelerated. In South Africa, we've got the same problem. We've had, a debt problem during the Zuma era that 2 terms that Mr. Zuma was in power, and that just blew out during COVID because there was the TERS payments, the COVID relief of distress grants that were given. So as a result, we're sitting now at over 60% debt to GDP, which is a very high number. And that's a global problem. Most countries, even China, is now, their debt numbers have gone up as well. And the tool that a lot of countries use is to do what is called deficit spending. They increase their deficit by spending more than what is coming in terms of taxes. And that then adds to the debt pile as well, which is what this graph is showing. So the world, that's staggering now, $1.3 trillion. The debt has increased by $315 billion, which is a massive. That's bigger than our GDP. The South African GDP is about 300 billion in terms of its size as well. So, and that's just in the last 3 months that increase has come through. So it's something that we're monitoring. Something has to give, and that is also why another question we always get is gold price. Why not gold? And gold has done well, sitting at over $2,600. This is one of the reasons why the gold price has done what it's done. The other reason is that countries like China and Turkey has been aggressively buying gold to diversify their reserves. That is coming to an end, so we would caution being too bullish on gold, given what the last 2 years has done. But this is a key reason why we're seeing gold prices being elevated as well. I think this is my last slide, and I'll conclude on this slide before we come back to the chat. It's really the tensions between China and the US. And as we know, in 3 weeks' time, Americans are going to go to the polls. They're going to vote for either Kamala Harris or for Trump. And, ironically, while Mr. Trump is probably the most vociferous and vocal about his anti-China stance, the Democratic Party that has been ruling the US for the last term, they haven't done anything in terms of changing course from the Trump era. So Trump was president previously. He had a lot of anti-China sort of rules and policy in place. A lot of that was kept by the Democratic Party in the last term. So we actually think that this theme of China and geopolitical tensions between China and the West and the US in particular will continue irrespective of who wins the election. It will probably be worse with the Trump administration come November. But that is why it's important to look at 2 elements. Firstly, the US imports from China, because the US is still the biggest economy globally. If they don't buy from China, China has to find alternative markets. And you can see what these stack graphs basically indicate, and rather focus on the totals. Currently, 2023, we're much lower compared to what 2022 was. and that was with the Democratic Party in power in the US. So we think that will probably decline further, and as a result, China will have to find alternative markets for their products, because the US will continue to reduce their imports from China. And the last graph is basically the opposite of that. China's exports to the US. Again, you can see how that has declined over the last couple of years as well. And so various components of that, I'm not going to go through the detail. Suffice to look at the actual numbers. And you can see that's been a declining trend since about 2021. And part of the reason is because of these tariffs that have been imposed on Chinese imports, from electric vehicles to aluminium and commodity imports as well. So hopefully I talked of all of the major themes and how it impacts the global economy. I think we can pause it there and maybe have another chat and then come back and talk about Islamic investments.
Okay, wonderful. I do have a few questions.
Okay.
So in terms of inflation, right? So we see that, as you mentioned, inflation is about 4.4% on the previous read. So we see that interest rates are more than likely going to be cut, right?
Yeah.
And what I've heard, what I've read, is that it would be cut probably into the first quarter of 2025.
Yes.
But how? Because you mentioned that it could be done quite aggressively.
Yeah.
But where do you see that in terms of that number? How much should it be reduced, and will it be at every meeting?
Yeah, so we look at it's all dependent on what inflation does as well, the inflation outlook. If inflation stays low and continue to track lower, what the Reserve Bank has done is they've tried to guide the market lower. So initially, and as we know, Tito Mboweni passed away recently. When he was Reserve Bank governor, we were anchoring towards the 6% because inflation was coming from double digit and it was coming down. So as we were more comfortable in the 6% area, they gave us this guidance of 3 to 6%. What the governor now wants to do is he wants it to track lower between 3 and 4.5%. So to the extent that, and there's various models that indicate that inflation could come down to as low as 3.2%. If we get it to that level, then there's scope for another at least 50 basis points cut in interest rates. And so, I mean, in terms of the frequency of it, probably 225 basis point cuts is what we're looking at. And I still think we're likely to see a cut before the year end, and then probably another cut next year as well. Okay. So people can sort of pencil in, if you're doing your sums and your budgets for next year, pencil in a 50 basis point reduction by March next year. Yeah.
Some well-needed relief.
Definitely, yes. Yeah.
Then also you mentioned, some obviously very concerning that Israel has already has plans to attack Iran. And the fact that they more than likely would attack the oil fields, which would then spike the price of oil. My question is, though, even though the Strait of Hormuz is going to potentially then be closed off, what we're also seeing now is that there's a lot of shipping coming around the Cape of Good Hope.
Yes. Yeah.
So how does that potentially benefit South Africa?
Look, we're benefiting in the sense that we sometimes our own worst enemies, in the sense that our ports have been having bottlenecks for a long time. So Transnet's ability to have port handling and servicing has been compromised for a long time. And that's why we're even struggling with exports. So if you speak to the mining companies, they'll tell you, our ability to export coal and manganese and iron ore, we're always under delivering because the port infrastructure is not conducive, the rail infrastructure is not conducive. So all of those are bottlenecks as well. The other challenge that we have is that because of mismanagement, Transnet's ability to spend capital effectively is also compromised as well. So in a way, whilst traffic has increased, I think we interact with a lot of global shipping companies, and they'll say that the frustrating thing of South Africa is that we don't get our act together. So even though these shipping lanes have opened up and more ships are passing by, a lot of them actually don't even stop here because our ports can't handle the infrastructure. So they either go to Maputo or they go further up the coast, maybe Namibia or elsewhere, and anchor there and maybe do refuel or whatever. So we're not getting the full benefit, maybe rightly or wrongly, for that reason. But shipping has increased. What it does do is increases the cost of goods and services because The stat that I saw, it's on average 21 to 28 days longer to go around the Cape of Good Hope, as they call it, versus just going straight through the Red Sea or any of those other sort of areas.
Okay, and then just on China specifically, and I don't know in some of the podcasts that I listen to and some of the things that I read, in terms of BRICS, and the purchasing of oil. So you mentioned that China has that soft demand, right? So the fact that we are, benefiting from the oil price because of that demand or lack of demand, could it also be that maybe some of the oil is now being purchased, but we're not aware of those transactions?
So that is another big theme that we've been exploring this year. So if you look at how global commodities are priced, they typically priced off commodity exchanges. So the three big ones are effectively the LME, the London Metal Exchange. You've got NYMEX, which is a New York Mercantile Exchange, and then there's a Shanghai one in China. The problem that you typically have is that if all of the market participants are not selling through that marketplace or market facility, you don't have a true reflection of what the true supply and demand is. And as we know, in LME, the London one, the European Euronext, which is another one, they've all banned Russia. And Russia is quite a big player. So at the last count, last official stats that we saw, Russia was the biggest oil producer. They were producing more oil than Saudi Arabia. So you're looking at about 12 million barrels a day of oil in a market that does about 90 million barrels a day. So Russia is substantial. And we suspect that a lot of that Russian oil is still being produced. It's finding its way directly to China and India, which are the two big purchase areas. And obviously we know that those countries don't have sanctions on Russia. So they would be purchasers of Russian oil. And because it's not going through the NYMEX or the LME or any of those exchanges, we are not seeing the full impact of that. And that's why you find that traditional oil suppliers like OPEC, for example, are finding it difficult to sell their oil. So now you have a surplus because there are more supply than demand of the official exchange, and that is also depressing the price as well.
Okay, yeah, that makes absolute sense. Just one more question on China.
Yeah.
Just in terms of tariffs and some of the trade wars that's going on between the US and China. Just around the semiconductor market, that seems to be a big theme now, where only old type of technology can be sold to China. And then obviously the issue with Taiwan. I know I'm getting into maybe a bit of geopolitics how does that also kind of affect us, as investors?
So that's very interesting because a lot of what you're talking to has happened in the last 24 hours, 48 hours. So the market, if you look at the semiconductor market, you've got three major players. You've got TSMC, which is a Taiwan semiconductor company based in Taiwan. Obviously, Taiwan the subject of a dispute with China, mainland China. China says it's a province of theirs. Taiwan says, no, we're an independent country. So so clearly that's an issue. The other major players are a company called ASML, which is based in the Netherlands. They produce the infrastructure for semiconductors. So they're not the semiconductor producer directly, but they do the infrastructure to allow semiconductor. So they'll build the big machines that you make the semiconductors on, for example. The other one is NVIDIA. And NVIDIA plays in a subsect of the semiconductor market. It's more the graphics market. And that graphics market is what is critical to AI and ChatGPT and all of these big machine learning sort of operations that require very high processing power from these semiconductors as well. So NVIDIA, obviously a US company, in the last 24 hours, the US has said, look, we don't want you, NVIDIA now, to sell your stuff to China, and certain aspects of your product you shouldn't be making available, which is a fairly new development. So we're monitoring that quite closely. What we've also seen in the semiconductor market is that outside of ChatGPT applications, the rest of the market is actually quite soft. And that is because a lot of corporates, they're prioritizing ChatGPT applications to the detriment to at the expense of the traditional semiconductor market. And that's why, the last sort of 24 hours, companies like ASML has said that, we're finding, it's a softer market. It's also impacted other semiconductor players as well. And the big risk is that, look, TSMC is a massive supplier to NVIDIA. If there's any disruption to that sort of flow, which could be a result of China issues, for example, it will have massive implications for NVIDIA. NVIDIA is now, I think, they're neck and neck with Microsoft in terms of being the most valuable company globally, about $3 trillion. So it's got a big implication for them if there's any move from China on TSMC as well.
Okay, so that's something to definitely look out for.
Definitely, yes.
Siraj, do you have any questions?
Yeah, well, I've tried to make some notes while you're going through the slides.
Yeah.
My question is, with energy, I think energy has become, critically focused, or rather, critical focus globally,
Yes.
especially with the transition to renewable energy.
Yes.
How is South Africa positioned in this sector, and what role do investments in the renewable energy, play in the local market?
Yeah, so it's a good question because South Africa, like most emerging markets, we have effectively what is called the black gold curse. So the black gold refers to oil, but it also refers to coal as well. And South Africa has abundant resources of coal, but we've also committed ourselves to various climate change protocols and objectives. One of the big ones is reducing global warming by 1.5%. So that's sort of the UN COP, Conference of Parties objectives is to reduce global warming and the impact of global warming through reducing the use of fossil fuels, which is oil, coal, all of those type of energy sources, in favor of renewables, your typical solar, wind as well. Now, South Africa, again, to answer the question, I mean, we have abundant natural sunlight and wind areas as well to exploit that opportunities. The challenge that we have is twofold. Firstly, the big challenge is Eskom. So Eskom, in terms of its ability to allow not only, so the easy part is to actually allow people to just self-generate and produce their own solar, produce their own renewables. The problem is that Eskom's infrastructure cannot handle taking some of those renewables and putting it onto the grid and making it mass available. So they need to spend capital to allow that to happen. And that's why we've seen, I mean, these renewable energy processes and partnerships has been going now for 15 years. So there's a lot of that happening, but we're not seeing the benefit of that from a consumer point of view because of the Eskom bottleneck in terms of the ability to switch on those alternatives as well. So once that happened, I think it would be a game changer. The first part is to break up Eskom into the three companies, something that government has committed to, that they've said in the budget, last budget, that they will do, but we haven't seen the political will to do that. Once you break Eskom up in terms of its generation, distribution, and effectively allowing third parties to self-generate and then to supply into the grid, that will enable a much better environment for renewables. The other issue is compensation. So if I'm generating renewables in either wind or solar, what am I getting paid? The incentive price is too low from a tariff point of view to allow significant investment. So what a lot of corporates have done, especially during load shedding, is to self-generate for own use. But the big opportunity is to self-generate or to generate for commercial use. And that is where the tariff regime needs to be sorted out as well. So those are the things that we're grappling with, and that's why we haven't seen the big advances like other areas in the world where they've made much bigger advances in terms of getting that energy mix right as well.
That's awesome.
Excellent. That's so interesting, and I think we can keep going all night long, just talking about this topic. It's fascinating for me. What I would like to do for our guests, though, and for our viewers, is just to maybe give them some insight into Islamic finance, or Islamic investments specifically in South Africa. And so, do you have a little bit of a presentation on that as well?
Yes.
Okay.
Yeah,
all right.
I've kept my firepower
Okay.
dry for this. So, we always get asked, what is Sharia investing? And surely it's just another fancy name for what you're doing on a conventional side. And there are some differences, but I think, to put it into context, and before I get into the slide, Allah Ta'ala talks about, riba and transacting in Surah Baqarah, and Allah Ta'ala says that, back in the day, the Jews used to say that, riba is just the same as trade, and there's no difference. Actually, the difference comes on two areas: the intention, and which is quite important from a religious point of view, but then also the execution as well. So to give you a simple example, if I want to buy a house, I can go to the bank and get a mortgage. Borrow. Let's go with a 3 million rand example, just to continue that. So the house is 3 million rand. I go to, I'm not going to mention banks' names here, it's a sensitive topic. Go to X bank and basically borrow 3 million and pay them back probably about 6.5 to 7 million rand over a 20-year period, right? That 4 million rand roughly is interest, right? I can, and obviously in terms of my payments, if you divide that on a monthly basis, you're looking at about 14,000 rand a month that I'm paying in terms of a bond payment, right? I can restructure that and say, go to a Sharia-compliant bank and say, look, this house is 3 million rand. The bank will say, okay, we will buy the house, pay the seller 3 million rand, and then on-sell this house to you for 6 million rand. Or even 7 million rand. Let's stick with the 7 million rand. You pay us back 14,000 rand a month over 20 years. Optically, it looks exactly the same. 3 million, 7 million, 14,000 rand a month. The key difference is that the one is a fully Sharia-compliant transaction, the other is a riba transaction. Why? How does it work? It comes down to those critical components of intention and the mechanisms that you're doing. So the one is clearly, my intention when I bought the house is to say, I don't want to be involved in riba. I want to be Sharia-compliant. So I'm going to go to the bank and say, you buy the house, I will buy it from you at a profit markup, which is totally legitimate, Sharia-compliant and above board. The bank will say, okay, we are taking risk, so to compensate us for our risk, we're going to make a markup on this house, and we're going to buy this house, pay the seller out his 3 million, and obviously then on-sell it to the buyer, and he pays us back in installments. Again, from a bank point of view, totally legitimate, Sharia-compliant. Where the issue comes in for the conventional banks is that they don't care about your house. They're there to lend you money. And in a worst case scenario where you can't pay them back, they're going to repossess your house. You're still liable for any difference in terms of the loan, they gave you and what they realized for the house. So the bank always wins. There's no risk sharing. There's no issue around ownership where the bank has actually been a partner with you in terms of that home ownership. And those are the key missing links, and why what we're doing on the Sharia side is compliant and why the conventional side is non-compliant. The same with conventional loans. If I'm lending money from you and you give me a 3 million rand loan and you say, okay, you pay me back my 3 million plus $1 million in interest, I'm going to win either way. Whether you can, by hook or by crook, I'm going to extort that extra $1 million rand from you. And that is what makes it oppressive. That is what makes, and then actually, it's not just an Islamic thing. It's actually a universal religious thing. It's just a lot of people don't adhere. It's an ethical thing in terms of saying that, where you're forcing a person that, you're coming, with your hand outstretched to make the loan, now you're further oppressing him by charging interest. That is actually abhorrent. And it's unethical, as you said. So that is the context of Sharia investing. And I think that's the big battle that we always have, is that people say, yeah, but it looks like the same. It's the same thing. You're investing in the same shares. It's a unit trust. My statement is the same company, all of that. That's all good and well, and that's to your benefit. But rest assured that our intention, our modus of execution, and what we're investing being compliant is the key difference and what it makes it Sharia compliant as well. So I think it's important to just give you that context.
Absolutely.
And with us at Camissa, we've been running Sharia investments now for 16 years. Alhamdulillah, our fund has grown from that 1 million, as I've mentioned. The equity fund is now 2.2 billion rand. Overall, we're managing about 6.5 to 7 billion rand across the various strategies. And I'm ably supported by a team. I'm not the only guy. If I get hit by a bus, there are, probably better capable guys than myself, supporting me in terms of our Sharia investment team, and those are the individuals on the screen there, as you can see. But just very briefly, it is late at night, so I'm not going to go through all of the details. But in essence, what are we trying to do with Sharia investing? We're trying to limit, and to the best ability that we can, eliminate riba and not invest in riba. It is virtually impossible in the sense that most companies that are profitable will have some cash in the bank and they will earn some interest. But there is a process that we have to purify that and to obviously donate that to charity, which is quite important. That's an important part of it as well. But qualitatively, what we try and also do is not, and we came back to the ethical investing part of it, where we're not investing in companies that are harmful for either humans or the environment or to society at large. So if you think of defense companies, armaments companies, obviously people being killed, that's problematic. Companies that are involved in alcohol, that's not good for society, not good. If you look at, and there's a whole host of studies that show, the link between alcohol abuse and incidents of car traffic or car accidents, for example, homicides and domestic abuse, all of those things. It's well known. Gambling, the impact that has on society, and broken marriages, broken homes as well. So all of those are problematic industries and companies, and we don't invest in that. The other component is around ethical investing and socially responsible investing. Islam, in terms of its foundational principles, is as Sharia compliant from an ethical and from a societal point of view as any other process that you would like to look at. And that's why on the JSE there are these SRI indices. You'll find large overlap between SRI indices, or socially responsible indices, and Sharia investing sort of indices as well. And that's because the underlying principles and foundations are very, very similar. So I think that's an important point to make. On the screen, there's just some metrics that we use to regulate and to monitor for too much debt and too much cash. They're fairly self-explanatory in terms of just the limits. And then from our commercial point of view, we have evolved over the last couple of years, because in South Africa, we've got a dual market. We've got people that have a lot of cash and, the ability to invest in unit trusts and buy shares. So for them, we've got equity funds both locally and globally, so they can invest in those funds. There are other people that might not have spare change and, spare 500 Rand a month to do a debit order, but they're working for a company that contributes towards their pension fund. So for those individuals, we've got what is called Regulation 28 compliant funds. These are funds that meet the criteria of the pension funds and retirement funds acts that we have in South Africa. So we've got an income fund called the High Yield Fund. We've got our Balance Fund, which are well placed to benefit from that. So in South Africa, we're quite fortunate in that this market is over 30 years old. It's a market that has evolved. The products have evolved as well. We've got now Sukuks in this market. We've got the ability to invest not only in equities, but in what is called yield assets. Alternative investments that protect you on the downside, that gives you a regular income and just reduces the risk. I always say that Sharia investors want the holy grail. They want the highest return with no risk whatsoever. I mean, on the slide, you can see, you get higher returns, but there's also the risk spectrum as well. So there is a natural trade-off. If you're going to go into a low-risk product, you should prepare yourself to get a lower return as well. But Sharia investors, they want the highest return with the lowest possible risk. And it's very different to where they lead their lives. I mean, they'll drive a very fast BMW, but say, no, I'm very risk-averse. But I think that's quite an interesting observation, because, we get a lot of interaction with clients and they say, your fund is doing like 6% or 7%. And then I say, well, it's a low-risk fund. It's outperforming inflation. Inflation is 4.5%. You're getting 1.5% above inflation, which is what the objective of that fund is. And then on the other hand, if they're exposed to the equity fund, in a good year we do 30%, in a bad year it maybe goes down 2%. And they say, you've lost me money, what's happening? So it's always difficult to get that balance right, but that's why it's important for people to get financial advice and to decide with your financial advisor where you are in that risk spectrum, so that the financial advisor can give you the best financial advice in terms of which product is most appropriate for you. I'm going to pause there, and maybe, I don't know if you have any questions.
Look, just in terms of Islamic investments, right? So 16 years ago, you started to get into Sharia-compliant investments, right? Yeah. And was it the equity fund that was the
Islamic equity fund? Yes.
Islamic equity fund that you initially launched. Why do you think the Sharia-compliant industry with Islamic investments hasn't taken off, and instead of it being at 80 billion or or maybe a larger number, and alhamdulillah for the success, but obviously we know that our community has so much more money.
Yes. Good point,
Why do you think those flows are not coming into these types of
I
portfolios?
Think that's the very important. I call it the 200 billion rand question, because So we've done research. If you look at the market today, across all of the various players in this market, the total sum invested is 20 billion rand. We've done an exercise where we looked at if you look at pension funds. So alhamdulillah, our Muslim community, they're very productive, they're very hardworking. A lot of our community have worked for very long periods of time at companies, they're well established. So we punch above our weight in terms of our economic power. Numerically, we're probably about 2 to 3% of the population. So if you take a population of say 60 million people, we're roughly 2 to 3% of that, right? But economically, we're probably about 10. In fact, the number that I saw was between 12 and 15% economically. So we're punching substantially above our weight in terms of economic power. And so what we've done is we looked at the total savings industry in South Africa, which is about 4 trillion rand. So it's a big number, 4 trillion rand. And if you take a crude number in terms of just the Sharia or Muslim members sort of money of that, we're looking at about 400 billion rand, right? Now, for various reasons, if you look at, for example, the PIC, that's the largest asset manager in South Africa, they don't give their members member choice. So a lot of our teachers and police personnel, all of them that are Muslim, they don't have the choice there. So we cut that in half and say that let's take half of that away. So from 400 billion, we're looking at 200 billion. So 200 billion is the number that we think should be available where people have member choice. They have the ability to say to the administrator, look, I'm a Muslim, I want to make sure that my money is invested in a halal product. Yet we're sitting at 20 billion. So that's why I call it the 200 billion rand question, because effectively there's 180 billion sitting out there that should be in a compliant sort of structure or product that is not. And we believe in our assessment is for 3 reasons. Firstly, and probably the most critical one, is lack of awareness, so lack of education. So that's why podcasts like these are quite important, because we need to share that message with our community, is that there are Sharia-compliant alternatives available. And, we're trying to do our best in terms of just creating awareness through various platforms to conscientize our community to say that, it is actually incumbent on you to make sure that just as you make your 5 daily salah, you go for Hajj and all of that, you need to make sure that your investments are also compliant. Because ultimately, if you're consuming product or consuming items that are from a non-halal source, it does compromise all other acts that you're doing as well. So that's the first point. And one of the first and probably the biggest obstacle. The second one is where people are aware, but for various reasons, either because they feel that the fund manager is going to steal their money or put the money in his pocket, or they think that Sharia funds are always going to underperform, and there's always that myth still that if you invest in a Sharia fund or Sharia product, you're going to get the less performance. And we've already dispelled that. I mean, our funds are outperforming conventional funds over long periods of time. And there are other funds that are performing ahead of our fund that are also, outperforming conventional funds. So I think that has also been dispelled. The third component is probably the most problematic, in that there are people that are saying that actually I don't care. I'm aware of it, but I'm happy to stick with my conventional. Look, we can't compel anybody to do what they need to do, but there is that component of people that say, look, we are aware of it, but we're not interested in it as well. So I think, at the very basic level, in the short term, we think that this market should be at 100 billion. So again, taking the 200 billion, cutting that in half, 100 billion. So the market could grow 5-fold from 20 billion, where it is currently, to 100 billion overnight, if more people invested in Sharia compliant investments. I just wanted to share why it's important. And obviously people have various levels of iman and taqwa, and not everybody's on the same level. But what we have seen is there has been cases where individuals that are in retirement, they've had member choice, they haven't chosen a Sharia compliant investment, and now 30 years later they're at retirement, and they've maybe got a payout of 5 million rand. In the entire life, the total salaries was maybe 1 million rand. Now he's getting 5 million rand, but now your conscience is pricking you, and you're saying, like, how much of this is truly compliant, and how much can I actually eat? And we've done a few exercises like that, and the numbers are staggering. From 40 to 50 to up to 60% of it is non-compliant. If you take 60% of 5 million, that's 3 million rand that you have to give away. It's hard for people that are in retirement that need to live off those retirement savings. So, for young people out there that are just embarking on the saving journey, you've got a great opportunity to fix it at the start, so that in 30 years' time, you don't have this moral dilemma of, do I consume this 3 million and not worry about my akhirah, or do I do the morally correct thing and maybe give it away, but then my retirement suffers because my quality of life in retirement will be compromised because I now have to give away a substantial portion of my life savings as well. So I think these programs and podcasts are vital to making sure that people are aware of these risks, because people go through phases, and alhamdulillah, I went for Hajj a few years ago, and the question and the comment I always got is, you're so young, why, look, despite the grey hair, you're so young, why do you go for Hajj? And I was saying, look, I'm young and I can go for Hajj. But a lot of people, they defer. They say, look, I'll change my life when I'm 40 or when I'm 50 or when I'm 60. By that time, your life circumstances would have changed, and your ability to change your life might be very different compared to now. So it's always easier to fix something and be in control of it, when you have the ability, than to defer it to a later stage where you might not have that ability as well.
Dol, that's very inspiring. I think I have one more question, and then I'll hand it over to Siraj, and then maybe we can end it there. But very inspiring, and I don't think I want to take it much further. But the one question I have for you is, when I look at the investment markets, I see that the Sharia-compliant investments are definitely on par with conventional investments. I see in many cases the Sharia-compliant investments actually outperforming the conventional investments. Also because of things like gold and the price of gold recently. Yes, and like you said, we don't necessarily want to be too bullish on it because of market conditions currently. But, I think I saw today that gold, for example, shot up above $2,700 an ounce. Record-breaking numbers, right? And when you have a portion of that, maybe 5% or less than that within your portfolio, potentially that also helps, from a Sharia perspective. But my question really around the Sharia piece is to say, what exciting investments or shares, or maybe give us an example there, something exciting, to get our audience excited about Sharia investing and some of the thought processes that go behind some of the shares that you pick.
That's an interesting one because, we're focusing a lot on our global side of things, which, a lot of people might not have the ability to invest globally. So I get excited about our unit trust, if I could punt that. But globally, I think there's some interesting companies out there. We've done a lot of research on the Japanese companies. We just find it paradoxical that they are excellent companies. And Japanese culture is such of one of trust and one of taking care of your workers and your company and all of that. And that resonates with us. So there's a couple of Japanese investments like Panasonic, for example. We all know Panasonic as the battery company, but they're also a large electric vehicle battery producer as well. But beyond that, they appliances, your air conditioners, all of that as well. So they're going through a tough time at the moment because electric vehicle sales have been lower. But we think that is probably a very good long-term investment. There's some Chinese companies like JD.com, which is also fantastic on a global sort of basis. A victim of these geopolitical issues between the US and China because they listed in the US, but it's a Chinese company. So US investors don't want to touch it, and that's creating the opportunity as well. Locally, there's quite a few companies that we have in the portfolio. Some of the smaller ones, maybe bringing it closer to home. A company like Sea Harvest, which we think is very well managed as part of the Brimstone Group, but one that we think is quite an exciting opportunity. It is, it does have natural competitive advantages as well. We just need the hake to play along in terms of the fishing market. But there's similar companies like an Omnia, for example, that we have in our local portfolio. People might know it as a fertilizer business, but they've got a business in Australia that does what is called humates, which is a cutting-edge fertilizer opportunity. And you only find it in Australia, and they dominate that market. and they're on the cusp of taking that globally. And we think that that is substantially undervalued in Omnia. So there's 4 examples of opportunities, hopefully, that people should get excited about.
Okay.
Abdulaziz, I think one of the biggest criticism or arguments made by the community is that Islamic finance as a whole hasn't really brought innovation to the market. What they're saying is we're merely mirroring what existing products are out there. People are saying Bitcoin was an alternative, as an example. What is your view on that?
Yeah, I got that a few times in the past. So there's 2 questions in there. The first question is around innovation. The second question is around Bitcoin. So on the innovation question, look, the reality is that the world of finance is always evolving. The most innovation has happened, unfortunately, in the non-compliant sectors of investments and finance, and that's on the derivative side. So you've seen these fancy derivative products. We think that a lot of that carries unnecessary risk. So a lot of those derivative structures, and if you think back to the global financial crisis, 2008, when you were out of your diapers, probably in primary school, back then a lot of those fancy derivatives, they collapsed because of the debt and because of the uncertainty. So, the beauty of Islam is that it regulates how, and it gives you a framework of how you should think of an investment. There needs to be certainty, not excessive risk, all of those components. And that creates a fairly stable area for you to innovate. So having said that, unfortunately, the global market has edged towards what is more cutting edge and more sort of risk taking in terms of where they want to innovate. So they've steered away from those principles. And that's why optically it looks like the Sharia market is not keeping pace, which from a product point of view is true. But the reality is that Islam is also saying that, stick to these parameters. And all of this might look exciting and might glisten very nicely, but actually there's too much risk. And history has proven that to be the case. If you look at most of these collapses that have happened because at the foundation, it's been a debt sort of issue, which Islam obviously regulates and abhors as well. Coming to crypto and Bitcoin in particular, like any commodity, like any asset class, we look at the fundamentals. We look at supply and demand fundamentals. And if you look at the original creation of Bitcoin, it was there to be a means of exchange. And the idea was that you use your Bitcoin to trade and to buy and to use as an alternative to conventional and the whole money issue. And that is still the case for a lot of people that want to invest and use crypto as a hedge against the monetary system collapsing. If you remember that slide that I showed you of the elephant in the room, that was the existential reason for Bitcoin. Unfortunately, that has changed. People are now buying Bitcoin as an investment because they believe the price is going to go higher. So, and I know a lot of young people, especially, they've got the Luno accounts and all of those things, and they'll tell you, I'm buying Bitcoin because I think the price is going to go up and I want to sell it next week and make money. So that is not the reason why Bitcoin was created, and that shouldn't be the reason why you invest in Bitcoin, because then you're just speculating. So fundamentally, I think Bitcoin potentially has a place in a sort of diversified portfolio. If you're taking a view that, like gold, and the gold point that Anis made, it's an alternative and it's a hedge against the monetary system collapsing because of high debt. But then you have to hold it for 10 years. You have to hold it for a long period and not worry about the price. And very few people are willing to do that. They want to buy it today, sell it tomorrow at 100% profit, unfortunately.
And I know we touched on some of the geopolitical tensions globally, such as the conflict in Gaza and the ongoing war in Ukraine. Is the impact on conventional investments the same on? Does it impact Islamic investments as well?
In terms of those geopolitical issues? Not to the same extent. Look, unfortunately, if you look at, firstly, the Ukraine situation has probably been more impactful, given that Russia is quite a large producer of commodities. If you, for example, look at the nickel market, where Russia was the biggest producer, it had quite a big impact on the nickel market. Similarly, the palladium market as well. We initially saw quite a big price spike upwards, and then demand, as people shifted away from dependence on palladium, we saw the price falling down quite substantially. The situation in Gaza, which is obviously very terrible, and our hearts go out to the Palestinians, and what's been happening there. Economically, unfortunately, it's been going on for decades. It's, multi-decade sort of issue. So the economic impact of that is fairly limited. We have seen, there's obviously a parallel issue around boycotts and divestment and sanctions, where some of that at the edge, we've seen the impact on some of the companies involved, the global company. We don't invest in any of those global companies, but they have seen lower sales. Companies like Starbucks, for example, have seen lower sales and lower profitability as well. That's probably been the biggest impact from the situation in Gaza in particular. But the wider impact we haven't seen, and that's because economically it's not a massive area of the world. And also, as I said, the history is such that it has been going for a long time. So unfortunately, the world has become accustomed to it, which is a sad thing and quite tragic, yes, as well.
Okay, cool.
And lastly, just to end off, Abdul, any advice for the teenage boy looking to get into or girl?
Yes.
Yeah, that's right. Sorry, looking to get into their first investment.
Yes.
What do you suggest?
The first thing I can say is I can't give advice. Ali, you're the best position. They must speak to you. Speak to your financial advisor. But, I always say to young people, and my son is now at university, and I tell him as well, if you are in a position to invest, that is, you are ahead of 95% of the world's population. Because young people and investments are not the same, in terms of, being synonymous. So young people genuinely want to spend. And we can understand that, if you're starting to earn a salary or have a casual job, for example, that first paycheck, you already have items that you want to spend it on. So that's just the nature of it. But actually, to get into the habit of saving is actually the most powerful thing. So just save. Don't worry about the product. Save and put some money away and be disciplined about it. And a lot of people say that we don't earn enough to save. Even if you put away 50 rand, be in the habit of keeping that money separate and start in that small way as well. The products and all of that will come later. The other thing that a lot of people don't do is that they don't budget. And budget is, if you want to save, you need to budget. Because if I'm earning, maybe a student at university, I get a vacation job, which I did when I was back. I used to work in a butchery, earning 200 rand a month. And that 200 rand, look, I was fortunate in that, my father said, okay, you give me your money and then I will give you something to spend on. And, we had that sort of, it wasn't an ATM, it was more like a deposit-taking bank. So, but that started, that's where it starts. Get into the habit of putting money away, even if it's with your parents. And, hopefully your parents are responsible to look after your money in that way as well. But that is by far the most important thing for young people. The type of investments. And also, I think, as I said, there's a lot of young high school students that, get pocket money, then they put it in crypto. These lunar pockets where you can invest as little, easy equities where you can invest as little as 50 rand, for example, fractional investing, which is great. It's great for you to learn. But don't, be dependent on it. And don't think of it as, I'm going to get rich quick and that's why I'm going to put all my money into it. Because it's going to end in tears and it's probably scarring you in terms of your thinking towards long-term investing as well. So play around with it, put some money in it, but don't put all of your money in it and diversify. If you've got in the fortunate position of getting pocket money or getting a substantial enough income to diversify your investments as well.
Wonderful, Abdul Davids. Appreciate your time. Shukran. We wish you all the success and we hope to have you on our show again soon.
Shukran.
Assalamu alaikum wa rahmatullahi wa barakatuh.